You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the podcast. Today, I want to talk about, should I pay my house off as soon as possible? Should I select the 15-year versus the 30-year mortgage? And won't I just be saving so much interest? Well, if you're just comparing a 15-year against a 30-year and the interest difference, of course, it will be less interest paid, but you have to remember and consider the opportunity cost of what you could have done with those funds had you not added them to the mortgage and sent in a higher mortgage payment using the 15-year mortgage as an example. So you'd be saving yourself from spending a certain amount of interest to the mortgage company, but you will also be giving up a lot of interest that you could have earned. Your typical advice from a financial professional will say a 15-year mortgage is great because you will pay less cumulative interest. You'll have a lower interest rate, although sometimes the rate is the same, but usually it is lower. They will talk about how you are building equity in your home faster. And this is something I'll be coming back to later in the episode. And how acquiring a 15-year mortgage will be great because of your shorter pay period. You may have a higher payment for those 15 years and not able to save as much as you otherwise would. But the big reason you are typically advised to do this is to pay less overall interest. Oftentimes, the 15-year rate isn't all that much less than the 30-year rate. You'll have a higher payment that it might be painful for a while, but then voila, your house is paid off and you no longer have a mortgage. But let's think about this a little more deeply. What else could you have done with the difference in dollars you would have saved every month by taking a 30-year mortgage? Funny thing, I'm sure you will all find this quite shocking. But to me, the first thing that comes to mind is I could have put that money through my life insurance policy, my whole life insurance policy. So you might save a couple $100,000, depending on the amount of the mortgage and the rates and everything, of course. However, what would that monthly savings have done for you had you put that money somewhere else every single month? Let me give you an example, at least as well as I can for only talking it out. I know that numbers can get confusing when you're not looking at anything. So let's say you're considering a $350,000 mortgage, which is really low for the area I live in, but I thought I would just do something that's maybe more normal around the nation. As it turns out right now, the average home price for a house in the US is about $335,000. So on this $350,000 mortgage that you're considering, the 15-year fixed loan rate is 6.41%, and the 30-year fixed loan rate is 7.04%. Now, these are just national average rates that I just looked up. So a 15-year loan at this rate, you would end up paying about $545,000 for the house, which is just shy of $200,000 in interest. Whereas the 30-year loan for the $350,000 at the rate of 7.04%, you would end up paying about $490,000 in interest. So that ends up being about $296,000 that you would end up paying in higher interest costs by financing for 30 years, which of course is disgusting. Who wants to pay all that interest and willingly give away all that money? The difference in monthly payment in this example would be about $693.62. This is the amount that you would be saving by choosing the 30-year mortgage instead of the 15-year mortgage. So now, when I plug this number into my future value calculator for 30 years at a rate of only 4%, I end up earning a total of over $483,000. Now, by doing it this way, I would end up paying out an additional $296,000 in interest than I would have paid doing the 15-year loan, but I would still come out ahead by roughly $187,000. Now, this is inside of a whole life policy. If I'm putting that difference in dollars into a whole life policy, and say you're 35 years old when you acquire this mortgage, your money will keep growing beyond the 30 years. And by year 30, your account cash value will be snowballing and growing quite well. So let's say these funds grow for 50 years. That would put your growth at over 1.3 million from just simply redirecting the difference in your payment from selecting a 30-year mortgage instead of a 15-year mortgage. That's $693.62 payment in this example. Now, people will say, well, my house, once it's paid off, then I will save that full monthly payment. But let's be honest, how often does that actually happen? Instead, we more often than not run into Parkinson's law, where our expenses rise to meet income. And if you're disciplined, you may end up saving a portion of that money once the house is paid off. But I feel like not a lot of people are going to send the whole amount into something that's going to be growing for them whole life or any other thing. Now, though, if you're extra disciplined and your 15-year rate was lower than your 30-year rate option, and at the 15 years you save the entire mortgage payment, then by the end of the next 15 years, you would have more funds than had you just only saved the difference in mortgage payments for those 30 years. However, again, usually that's just not likely. That just doesn't happen. Like I said, usually expenses rise to meet income. So as soon as you can see your mortgage is about to be paid off, well, most people would see that freed up money and think, oh, I could use a new car. Maybe we should get a boat or an RV. Let's go on vacation. Like, what can we do? Our mortgage is going to be paid off. Not a lot of people are thinking of, oh, good, I could put this whole amount of money into a savings plan or a whole life policy. There are some out there, I'm sure, but just not the majority. Another way to think about it is that during that first 15-year time period, you would be accumulating a large cash value in your whole life policy that could be used for anything. It could be used as emergency savings or any other thing you can think of, buying other cash flowing assets such as real estate, rather than just creating a larger equity, which you would have to ask the bank if you could borrow, and then it's up to the bank to allow you access to that equity in your home. And then while you're using those funds for an emergency or real estate, if you have them built up inside of your whole life policy, because you decided to take the lower mortgage by taking the 30-year rate and having a lower payment and putting that away into a whole life policy. And now it's been building up and now you need to borrow against it for any reason. It's accessible to you. There's no question. There's no application. And while you're borrowing that money, it is still growing for you. That is super powerful. In addition, I've mentioned before that in 2008, I know of people whose ability to borrow using their HELOC was taken away because of the housing market crisis. So being able to borrow against your home equity is not always a guarantee. Another thing to remember is that paying in cash for things means you will never earn on that money again. So looking at this another way, if you had the $350,000 in cash to purchase the property upfront and would be able to save roughly the $195,000 in interest that you would have paid with a 15-year mortgage, it would definitely be better to run those dollars through your whole life policy. Having that $350,000 earning at 4% for 30 years would get you to about $1.2 million by the end of 30 years. And like I mentioned before, if you had 50 years, that would look more like $2.6 million. Therefore, my opinion in general is always to run that money through your life insurance policy first, and then use the funds to pay off your house, pay for your property, rental property, or whatever other use you have in mind for those funds. Now let's switch gears here a little bit and think about inflation. Dollars buy less as time goes by, and so your mortgage ends up feeling less and less or less expensive over time. With rising house prices, your mortgage payment will seem lower and lower and will be much lower than those with new mortgages, 20 years out. A 30-year mortgage today at $2,338 will feel like around $300 per month 30 years from now. A 15-year mortgage won't have the same experience, the same inflation as a 30-year mortgage. Earlier, I mentioned how typical advice will talk about how you will build equity faster if you're paying your mortgage down and how that's a good thing. Well, for me, I would much rather build equity in my whole life insurance policy because that is equity that I own. rather than equity in my house, which can go up and also down with the market. And that equity isn't automatically available for you to use. Like I said, you have to apply to borrow against your house, as everybody knows, and it's up to the bank if they will give you the loan or how much access they will give you to your equity. In addition, have you ever asked yourself, how much does the equity in my house earn for me? If you did, you would realize that the answer is dun, 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 nothing. Building your equity isn't causing your equity to earn anything. Increasing your equity does not increase the value of your house. It will increase how much you can borrow against your house, but that's only if the market doesn't take a nosedive right at the time you had planned to take a large HELOC for one reason or another. Or it could take a nosedive right when you're wanting to sell your house and move somewhere else. For example, let's say you are working hard to pay down your house and sending in extra payments every month. Your house is worth, say, $1 million and you owe about $100,000. But then home values start going down. I mean, with all the crazy in the world on a regular basis these days, I really don't think we can assume that the housing market will never have another bad day. We just have no idea what it's going to do. Now, is it likely to be higher over time? Absolutely. But still, in the moment when you need to sell your house, that doesn't mean, or when you need to access your equity, you have no idea if it's going to be right before there's something that happens in the economy that causes housing to go down in price. So your house that was worth $1 million is suddenly only worth $600,000, for example. In that moment, you basically lost $400,000, or at least you lost access to roughly $400,000. Since I've never heard of a bank giving you access to 100% of your equity, so having the opportunity to ask the bank if you can borrow against some of the current value in your home or property, and then have to go through the detailed and painful process of applying for those funds, because that's no fun, is nothing like owning the equity that is the cash value in your life insurance policy. You need money? No questions asked. You're able to access those funds right away. No questions asked, like I said before. You are able to access those funds right away. No application, no anything. Just, I need my funds and here you go. Comes right over to you. In a life insurance policy, you are building up true equity and actual cash that can be used for emergencies, home maintenance, or remodel needs. Ownership that allows you to borrow against that account whenever you darn well please, because it's backed by your own money. Equity that's guaranteed to grow and also will leave a much larger legacy. Equity that can't be lost in a housing market downswing. Equity that can be accessed for long-term care need, like say you need home care or assisted living. And not only can you access your equity in your life insurance policy for a long-term care need, but you can access up to 50% of the death benefit, which will give you access to more money than you have in equity in your policy. And if you plan to stay in your house through your old age, and if you plan to keep it as a rental, you're going to stay in it or you're going to rent it, and you simply want to pay it off because you want to get rid of that payment, you want that payment off your back as soon as possible, well, of course, I totally understand that. Pay it off if that's what helps you sleep at night, if that's what brings you peace of mind, and you want to know that that mortgage payment will be gone and it's something you don't have to worry about because you're going to be in that house for your last years. Then of course, do what feels right for you. Although there is one more thing I just wanted to mention as well that you should keep in mind, and that is that currently when you sell your primary home, you are able to keep from paying any tax on $500,000 up to $500,000 of your gains as a married couple. If you're single, it's $250,000. And so if you're married and you have $1 million in equity when you sell your house, you will have to pay tax on $500,000. I just thought some of you might not know that, so I thought I would mention it. And another thing, if you are determined to pay off the house and you also are excited about the infinite banking concept, it's also possible for you to move that debt over to your banking system to build it up and then pay off your house with the funds inside of your banking policy. And now you have those dollars earning for you for the rest of your life, earning interest and dividends and growing, and you can still pay your house off. And you're just going to at least capture the earning power of those dollars before you pay your house off. This way, you will be earning a large share of the interest rather than the bank. Well, that wraps up my topic for today. If you would like to work with me and connect to get started, please reach out to me. You can reach me at Valerie@alphaomega infinitewealth.com. I hope you have a super great week. I hope this was helpful or interesting. Thank you for listening.
This is thepodcastfactory.com.